United Parcel Services, or UPS, is alongside with FedEx the biggest multinational shipping and transportation company, without which many smaller businesses would cease to exist. And over the past year, they are down by 17.5%. Now, today I want to figure out whether this huge drop in price is rational, or if it's not, and UPS will rise over the next few years and bring its investors great return. And to do this, we will of course use our stock valuation spreadsheets, where we'll have a look at the fundamental 9-pillar analysis and calculate the intrinsic value of the company using our 4 valuation models. Now, first of all, we need to plug in the ticker UPS and wait for all the metrics to show up. Now, right away, we can see that they are a dividend company. They currently have a dividend yield of 5% with a dividend payout of $6.52 and quite a high trailing free cash flow payout ratio of 65.50%. Now, you all know that I like the trailing free cash flow payout ratio to be below 50%. Now, I don't really mind UPS's being at 65%, as the company doesn't need to push a lot of their free cash flow into innovation. So the 35% of the free cash flow they have left over after paying out their juicy dividend is enough to buy back shares, raise their dividend into the future, and pay off their debt. Now, jumping straight to the 9-pillar analysis, we can see that the company gets a rating of 7 out of 9, which is a fairly decent rating. Now, right away, we can see that the company has a consecutive dividend growth of 12.45%, which is a very sweet consecutive dividend growth. And with a high dividend yield of 5%, this makes UPS the ideal company for value dividend investors that are looking for the sweet dividend snowball effect. They have also been increasing their dividend consecutively over the past 15 years, which means that if you were receiving $100 in dividends 15 years ago, right now you'd be receiving about $300 in dividends from that one investment you made 15 years ago. But we can see that year over year they grew their dividend by only 0.46%, so that is something we have to take into account when predicting our future growth for the dividend discount model. Now, looking at the other values, we can see that UPS has been decreasing their shares outstanding at a rate of 0.30% yearly over the past 5 years. I'd like them to be decreasing it a little more aggressively, as they are trading at much lower values than they have been over the past few years. Now, looking at their 5-year profit margin, that is sitting at 22.82%, which is in the range we like to see. And the long-term liabilities over the 5-year free cash flow negative dividends is sitting at 0.92, which means that with the free cash flow they generate, they won't have any issues paying off debt and paying out the dividends while increasing them. Now, let's have a look at the 2 pillars in the red. The 5-year PE ratio sitting at 45.68 over the past 5 years, and the price to free cash flow sitting at 24.91 on average over the past 5 years. Now, what these 2 ratios essentially mean is that over the past 5 years, investors were overpaying for the company's earnings and for their free cash flow. But let's have a closer look and see how it is looking right now. So right now the P/E ratio for UPS is sitting at only 19.41, which would hint that they are slightly undervalued compared to the earnings they generate. And we can see the nice decrease in the P/E ratio through the past 5 years, decreasing at a rate of about 4.12% yearly. Now, jumping to the free cash flow, the price to free cash flow, we can see that that is currently sitting at 21.74, so only slightly overvalued. But I personally wouldn't mind paying the 74 cents in premium. Now, if these spreadsheets interest you and you find them helpful, make sure to check them out at the link in the description. We are currently running a Christmas discount, so don't miss out. Now, moving back to the 9-pillar analysis, we can also have a look at the growth of the company. We can see that their revenue has been growing at a rate of 4.53% yearly over the past 5 years. Their free cash flow has been increasing as well, and their net income has been increasing as well. Now, let's have a closer look at these three. We can see that the revenue has indeed been growing very nicely. If we have a look at the net income, we can see that that as well has been increasing quite nicely, not at 184%. This percentage is so high due to the increase from 2020 to 2021. Now we can see that from 2021 the net income has actually been decreasing by quite a bit. We can see that on the graph here as well, and year over year it has decreased by another 15.53%. So that is something we have to keep our eyes on. Now, moving to the free cash flow, we can see that that as well has been growing until about 2021, and since then it has been dropping, and year over year again down by 14.21%. Now, although both have been dropping over the past few years, we can see that there is still increase over the past 5 years from 2019 from 4.4 billion to 2023 to about 6.7 billion. Same with the free cash flow increasing from 2.2 billion to about 5 billion in 2023. So there is some increase. So overall, the 9-pillar analysis for UPS is looking quite decent. They have increased their revenue, their free cash flow, and their net income over the past 5 years, so since 2019. Now, I wouldn't mind them decreasing their shares outstanding a little more aggressively and having a slightly lower price to free cash flow. Now let's finally calculate UPS's intrinsic value, first using the Graham's formula revised. Now here I plugged in the high earnings per share growth estimate at 14%, the medium earnings per share growth estimate at 10%, and the low earnings per share estimate at 6%, and got an average 5-year earnings growth estimate of 13.06% when averaging out this with the analyst projections. We then take the 5-year earnings per share, the base PE sitting at 7, our projected growth rate, the growth rate multiplier sitting at 1.5, the average yield on AAA corporation bonds and the current yield on AAA corporation bonds, and using the formula laid out for us by Benjamin Graham, we get an intrinsic value of $226.25, which is 43% higher than the current trading price of the company. Now moving to the second of the 4 valuations, the discounted cash flow model, where we take the free cash flow of the company and calculate the future growth rate of 11.3% using the same method as before. Now using this growth rate, we calculate the future free cash flow, and then plugging in the discount rate at 8.1%, we calculate the present value of that future free cash flow. Then summing all of that up, adding cash and cash equivalents, we subtract total debt and get an equity value, which we divide by the shares outstanding and get an intrinsic value of $226.89, again quite higher than the current trading price. Now moving to the multiples valuation, where we compare UPS to 2 of its competitors, FedEx and EXPD. We take these companies' current stock prices and divide by their earnings per share to get their PE ratios. We then average these PE ratios out and get an average P of 20.15, which we multiply by the earnings per share of UPS and get an intrinsic value of $133.45. And this tells us that UPS is currently fairly valued compared to its earnings in its sector. And now moving to the final valuation model, the dividend discount model, where we take the dividend payouts over the past 5 years and calculate the average growth rate at 15.45%. Now, as we can see, the growth is quite skewed. So as I want to be conservative, I will plug in a high growth at 6%, medium growth at 5%, and low growth at 4%, and calculate the future growth rate of 5%. And then when combining this with the discount rate we already plugged in our discounted cash flow valuation, we get an intrinsic value of $218.41. And now moving to the ultimate valuation, where we average out all the 4 valuation models and get an ultimate intrinsic value of $201.24, which is 57% higher than the current trading price of the company. And if we plug in a margin of safety of 25%, we still get an acceptable buy price at $150. Now currently the market is experiencing a huge boom in AI and tech companies, which are very often trading extremely expensive compared to their earnings. And then there are companies such as UPS, which have been looked over and are very undervalued with very healthy portfolios. And with that, I hope that you enjoyed the video. Make sure to leave a like and subscribe, as it really helps me out and it's free.